Okay, welcome. You are here at the week one of It's Your Money webinar for spring 2021. My name is Trevor Murphy. I am currently the CEO President of Financial and Estate Literacy. We are a small nonprofit that aspires to provide the attendees here with educational and practical solutions to financial planning, estate planning, and charitable planning issues. We want you to be in charge and in control of your finances and estates during your lifetime and beyond. These workshops are a free community resource and service for education only. We are not selling anything, and all of our volunteer professionals that will be volunteering, the financial advisors and attorneys, are also not selling anything. Let's see. We still have people joining, but I will just start it up. I'm going to share my screen. And let's see, 1 second. Oh, here we go. Okay, 1 second. Back to here, share screen. In front of you now is our website, okay? You will be getting confirmation and reminder emails 1 day ahead if you've signed up for the It's Your Money series, so that would be on Tuesday, and hopefully 1 hour before we start. Our It's Your Estate series will be the same time, but on Wednesdays for the next 8 weeks. So you'll be getting those confirmation emails on Tuesday and then 1 hour before we start on Wednesdays. Just so you know, you cannot turn on your audio or video. That is part of the webinar settings rather than a Zoom meeting setting, which is a little different. This is a Zoom webinar we are in. You can use, there's a question and answer button that if you have questions that I will see them and we'll be fielding questions. Some of them I will pose to Pete, the moderator, who I'll introduce one in a second, or to the financial advisors. Others I may just answer personally myself so we don't interrupt the flow of the presentation. Let's see. All these sessions are being recorded, and you're going to be able to find them on the website, which I can show you. So in case we go through some material very quickly, or you want to understand it better and watch it again, you'll be able to do that. And we've got a lot of good feedback regarding that ability to do that. Also, handout materials, okay? On your confirmation emails and reminder emails, there is a link directly to the materials for that week. But if you want to find them on our website, I'm demonstrating here. Here I'm going to do this. Draw. Spotlight. Okay. You can go to the workshops tab, or you can go to the either one, and that'll take you to our page here. And you see these buttons right in the middle of your page. You have It's Your Money and It's Your Estate. And then below, you can click on for our schedule for this spring, how to register if you want to share it with your friends. There is also a Zoom tutorial, sort of how to set that up if you're unfamiliar with Zoom. And then on this final tab is a materials page. So I'm going to click that, and it's going to take you through and ask you which series you are currently in. And a lot of you have signed up for both series, so that's wonderful. But right now we're on It's Your Money, and it takes me to week 1. And you can see week 2, week 3, all of these are going to be populated as the weeks go on. as we do week 1, you'll have a webinar. We need to change that to spring because it is spring. But the webinar video will be there once, and hopefully by tomorrow it will be edited and put up on the site. Our handouts from our volunteer professional financial advisors and attorneys will be the second material there. And then we will be going, you'll have an Ask First forms, which Pete will talk about later. These articles that come down, these are personally curated by our fearless leader, Peter Kote, and they are ancillary materials that are pertinent to that topic of that week. And I'll have Pete will explain that a little more as we go. I want everyone to understand that we are, we are sponsored by charitable sponsors only. We have no for-profit sponsors, and Pete will also explain the reason for that later on. But you can go to our sponsors page, and these are currently the charities that are we are helping to get their message out through our workshop programming. Normally, when I say normally, I mean during times of pre-COVID, we would be at sites all over Orange County, at community centers, senior centers, public libraries. But of course, that is we're unable to do that. And so we set up these webinars, and I really want to thank our philanthropic advisor, Don Vivret, for spearheading that last fall and the spring before that. This is our 3rd series for it, but we're hoping that hopefully by this fall, we can get back to live in person, because I really feel that is the essence of our programming is that live back and forth. Although we will probably continue to do a webinar series as well in conjunction. So that is all the housekeeping that I have for now. I'm going to stop sharing my screen. Actually, I'm not going to stop sharing my screen. I'm going to put up, no, not that. Okay. Let's see. You know what? I lost. Oh, there it is. Okay. I have.
You want to put up the questions, Trevor?
Oh, the poll.
Yeah.
Thank you, Pete. Okay. Let me stop sharing. We want to take a quick poll, and it's only 3 questions. And I would like you guys to just answer the questions in your own speed. Well, right now, actually, but the first one is, are you currently using a professional to assist you in your financial affairs? And then the second one is, if you have a professional financial advisor, are you using a broker-dealer or a fee-only financial advisor? And the final one, what age range are you? Because we want to have an idea of, now these are all anonymous. We don't know who's answering what question. So I'll let those populate a little bit. Okay.
So the audience members just click on the appropriate answer?
Correct. And we got we're up to about 60% of people who voted. And then let me give it another minute, and then I will broadcast the results.
Yeah, this is just so that we know kind of who the audience is and how do we gear the topics so that we cover issues. Many financial advisors with people in their 40s and 50s talk about retirement planning. Well, my feeling is that most of us are retired, so we kind of can avoid that topic.
Okay. All right. So we've got about 90% in. So I'm just going to end the polling and see what. Can everyone see that? I don't know if I'm
the polling you just took down.
Oh, I did. Okay, I'm going to share results. How about that?
Okay.
Okay. Whoa. Okay, so so you guys know about almost 70% are not using a professional currently for their financial affairs. Quite a large percentage, Pete, about almost 70% don't currently have a financial advisor. 15% say they use a broker, and about 13% at the fee-only financial advisor, and then 4% they don't know what their person is.
By the way, that's very common.
Yeah, no, it's very common. So it's good to know. And then if you can see the age range, Pete, a little over 54% are 65 and older, 21% between 50 and 65, and then 15% 35 to 50, and then there's 10% under 35. So, I mean, Pete, you can explain a little bit as to sort of historically I'm gonna stop polling, sort of the direction of or the, you know, that a lot of our programming is geared towards 50 or 65 and older, but everyone can use this.
Yeah.
Okay, so I'm going to share the screen. Here is Marty's Ask First, and then I'm going to hand it over to Pete.
Go ahead and click on the close the poll results.
Oh, it didn't do that?
Okay, there we go.
Okay.
All right. Marty, why don't you come on board? Welcome. Why don't you go ahead and turn the microphone on.
Good
That's
morning.
great. Yep, we got you. Yeah. On the materials handout, first of all, welcome everyone. My name is Peter Kote. I started these workshops, almost 25 years ago. It's hard to, how time flies. And what we kind of started with most of the program is that when I asked a question as to why you chose a financial advisor, most people responded with that the individual is really a nice person. And by the way, it's really important to be nice if in a professional capacity. But when we're talking about money, there's some other things that are just as important, if not more important. And so a friend, Ed Long, who started a program called HELP, H-E-L-P, out of Torrance, put this Ask First form together. And we use this Ask First form for all of our presenters. I use it in my practice as a fiduciary. If I don't know someone, I asked them, and they're in the financial services business, I asked them to complete it. Marty, how long did it take you to complete this form?
The first time I'd say it was 10 minutes tops.
Okay, yeah. So it doesn't take a long time to complete. Were you offended by any of the questions that were on the form?
No.
No, okay. So the idea being that when you're hiring a professional, they work for you and you're the employer, they're the employee. And there has to be some mutual respect there as to what you're getting. So the first question, by the way, in the materials page, we put a blank Ask First. I think this is one of the more useful items of the series and recommend it highly if you're going to interview individuals that you ask them to complete the Ask First form before you meet with them so you have an idea as to their background. So here's Marty's completed Ask First form. You have a bachelor's degree. What do you have your bachelor's degree in, Marty?
It's a Bachelor of Science. I studied accounting and finance.
And okay, so good background to have for education. Credentials. What's your talk a little bit about those two credentials? Are you a CPA or are you a financial advisor?
I am a CPA, but the services my firm provides are not traditional accounting services. The services we provide are more along the lines of a financial advisor. So we provide investment management and financial planning services. So I have that CPA credential, but and I did prepare tax returns in the past, but that's not something that we do today.
And your CFP, you're a certified financial planner as well. And what is a PFS?
A PFS is a designation that's available to CPAs, right? CPAs can do a lot of different things. We tend to think of CPAs as the guy or gal that does our tax return, but that's not always the case. And so the PFS is a specialist credential within the CPA realm that is a personal financial specialist.
And similar to the CFP, I would assume.
It is.
Yeah.
Yeah. The course material that you study to pass the PFS exam is nearly identical to the material from the CFP exam.
Okay. The important thing is that to understand the difference between a credential and a designation. And in the financial services industry, there are probably about 120 different designations. Most of them are not credentials. They're literally paid for designations. And the reason why there are so many designations within the financial services industry is because people seem to trust people who have a designation behind their name, even if they don't know what it really means. So in order to be a CPA, you can't just sit down one day and study for a week and pass the CPA exam. I'm assuming that is correct, Marty. That
would be very difficult to do. That's right.
Yes. And the same thing with the PFS and the same thing with the CFP. Those are extensive education courses, and they require continuing education credits, and they're recognized as credentials. Would you say your credentials are more important or your 18 years?
Oh, wow. Yeah, I would say the credentials are probably just a good starting point. I mean, even if I had 3 years of experience, I'd still be ahead of a lot of the advisors that had more years on the resume, but not those credentials.
Yeah, the 18 years is really important because that's where you learn what real people have issues with. So we're going to talk a little bit more about that. You have a license number for being a certified public accountant, and you have a Series 65, which is not really a license, it's more of a registration. But talk a little bit about what is the Series 65, because it's quite confusing.
Yeah, and there's all sorts of different series exams that you can take. I have the 65, the 7 is one, there's the 63, the 66. At the end of the day, what the 65 allows me to do is it legally allows me to give investment advice. I took an exam and learned the laws around what we need to follow to give investment advice.
And it's issued by FINRA, but it's controlled by the SEC, Securities and Exchange Commission.
Correct.
And if they're willing, if they wanted to look you up on FINRA, what would they do?
Yeah, so you can search by name or firm. So my name, Marty McNamara, or you can look up my firm, Merrick Wealth, on the website. There's advisor search feature on the website that you can look at.
Yeah, you can also go to what's called broker check. And so, and it'll let you know whether or not Marty had any disclosures or misconduct on file. It's very important to check individuals out. And everyone who's in the financial services industry has to be registered with FINRA. Now, Series 65, does that allow you to sell financial products?
No.
Okay. So by law, you cannot sell mutual funds or limited partnerships or stocks for commissions.
Correct.
Okay. Which is, I think, very important for you to know. Series 7, on the other hand, would allow Marty to sell products. Legal services, he does not practice law, which is a good thing. And the business relationship. You put down here true. What does that mean to you?
So as a fiduciary, I always put my clients' best interests first and foremost in the recommendations and advice I provide.
95% or thereabouts of professionals in the financial services industry would have to put false under that relationship. A broker who has a Series 7 license would not be able to put down that they would serve as a fiduciary. And so this is probably one of the more important check marks in picking out a professional. The other thing is that's just as important is, how are you compensated, Marty? You don't take commissions, so how are you paid?
Yeah, I'm paid a salary as an owner, an employee in my firm, and then because I do own the business, I also am paid via profits from the firm.
And then how do you charge your clients?
We charge two ways. One is hourly. So we have an hourly fee that we charge for our time. And the other way is a percentage of investments that we manage.
Okay. Give me an example of when you charge an hourly rate.
We charge hourly for clients that engage us for financial planning services.
And what is that hourly rate?
$420 per hour.
Okay. And so what is somebody who has a $2 million estate, a small business, what would a financial plan approximately cost?
It's going to range probably in the $3,000 to $5,000 price point would be where I would expect that engagement to end up most of the time.
Okay. So payment will be made by, so you put down Merrick Wealth. Merrick Wealth is your company, correct?
Correct.
And Merrick Wealth is the one that's also registered under a Series 65?
So the 65 license is tied to me personally.
Personally, okay.
Yes. I'm an investment advisor representative.
Okay.
And then Merrick Wealth is a registered investment advisor.
Okay. Let's say you were working for Merrill Lynch. And so if you were working for Merrill Lynch and I was a client, would I be paying you as a person, or would I be paying Merrill Lynch?
You would be paying Merrill Lynch.
And so if you were working for Merrill Lynch and Merrill Lynch paid you, who would you feel more obligated towards?
Merrill Lynch.
Yeah. So this is kind of a subtle way a payment will be made by, but it's really important to understand how the money flows. Okay. It's very similar to for brokers, how they're paid as real estate agents. When you're a real estate agent, you get a commission when you sell the house. Well, part of that commission is also goes to First Team or Coldwell Banker or first whatever the broker is, and then part of it goes to the agent. So and they negotiate. The agent negotiates with the firm as to how much they get paid. So the financial services industry operates on a very similar type of level, except for the fee-only fiduciary advisors. Financial products, do you offer or sell annuities, or are you affiliated with anyone who does?
No.
Okay. Do you accept referral fees?
No.
Do you give referral fees?
No.
Okay. Do you have any kind of internal contest where, you know, that the firm gives away free trips, etc.?
No.
No. Okay. These are all very common tools that brokers use to incentivize their sales force to sell products. And you don't want to be part of that. So, or even affiliated with that. Approximately how many clients do you have in your firm, and how many advisors do you have in your firm?
We have approximately 70 client families that we service, and those families are served by 2 lead advisors, myself and my business partner, Patrick Chu.
Okay. And what is your kind of your goal? How many financial clients can you take on individually as a firm before you need to add financial advisors?
Yeah, I think that's going to be 40 to 50 families per lead advisor would be what we would expect. So by the time we got to 100 families, we would certainly need to hire another lead advisor at the firm.
Yeah. The reason why I've asked Marty this is because the typical broker within a Merrill Lynch, UBS, Bank of America, Wells Fargo advisors, a typical broker that's been in the business 18 years is expected to have 3,000 to 5,000 clients. 3,000 to 5,000 clients. And what you just heard Marty say is that, hey, if we get up to about 100 or a little bit over, we're going to have an additional advisor. What's the difference between you and a broker?
Yeah, so you touched on the way that we're paid, and I think that's an important distinction, because 100% of our revenue from our firm comes directly from our clients. Brokers, that's not necessarily the case. They can get revenue from their clients, and they can get revenue from financial product companies, insurance companies, mutual fund companies. So that, I think it's a little less objective in that regard.
Most brokers, I don't think, offer financial plans.
Right. Some will, but I would say that their focus is typically not on financial planning.
The other thing too is that in the traditional investment world, I'm talking about maybe prior to 1970, a financial advisor primarily was sought to pick out a good investment and make money for their client. Is that still true today? Is that in your typical work with clients, is it all about just picking out the right investment?
No, that's one of many things that we're helping clients with.
Talk a little bit about that.
Yeah. So I think the approach today, especially at our firm, is more holistic. So we're not focused on just one account and investing money in one account. We're looking at all the client's assets, liabilities. We're looking at their income and expenses moving forward. So I think that's one thing that we look at. The other thing that we're looking at is their legal documents, trust and estate plan documents. If they have those in place, and if they don't, recommend the appropriate documents that they need. Insurance policies. We don't sell insurance, but we do feel that it's important to have the right insurance. And so we want to help clients with those decisions around risk management.
Do you work with people on their budgets, cash flow?
Yes, certainly. That's something that we incorporate into the income and expense conversation with them.
Yeah. And one of the biggest issues is that when you buy and sell stuff, taxes always comes into play.
Taxes is huge. It's a major expense for most of us. So one of the things with your background as being a CPA, you work with the client's CPA to take advantage or to make tax-wise decisions. Correct. Yes, we're involved in income tax planning. And the way we start that is by reviewing clients' most recent tax returns to understand their tax situation, and then asking ourselves questions around what can be done to minimize the amount of money that's being given to the government.
Okay.
Sorry guys, I have a question from an attendee, Marty, asking if you have a minimum of assets under management that you have to engage your services.
And I'll go along with that is that as well as what is that percentage of the fee? So okay. If your minimum is?
Yes. So our minimum investment amount is $1 million. And we charge 1% per year of the investments that we manage.
On an annual basis, paid quarterly?
Correct.
Okay. Let's go to the next screen because we want to know a little bit more about you.
Okay, so I'm going to stop sharing, and then Marty, you go ahead and share.
Okay. Okay, can everybody see tax update?
Yes, we can see it.
2021, great. Okay.
Let's go to the next slide, Marty, and let everybody know a little bit more that you're actually human.
There you go. Yeah, so the most human part about me is probably that last bullet point. That I'm married with 3 kids and a golden retriever. And I enjoy it. Yeah, the other, is focused more on my professional life. But I started my career in 2003 at Deloitte. That's where I prepared tax returns and got a good background in taxes, and but learned pretty quickly that wasn't something I wanted to do with my professional career, and moved into wealth management. And I've worked at some different wealth management firms, but in 2012, founded my company with my business partner, Patrick. The name of the company is Merrick Wealth. And so that's what you see on the slides here. And my practice is really focused on helping families with investment portfolios in the $2 million to $10 million range. We've got clients that are above and below that, but I would say that that's going to cover about 80% of our clients that we service.
Okay, let's get into because taxes is such a huge part of people's financial plans, that every single time an asset is sold or purchased, taxes need to be taken into consideration. So Marty, why don't we lead away? You've got the controls. Let's go through it, and I'll sit back and listen.
Great. Okay. So these are the 4 things we want to touch on today. We're going to briefly touch on the federal gift and estate tax. There is a session tomorrow that's going to get more into detail on that for the It's Your Estate attendees. But I do think it's important to touch on that briefly. We'll get into income taxes. So that's going to be federal and state income taxes we'll touch on, and then we'll talk about potential changes to the law and planning considerations that come along with those changes. Okay, so this is the one and only slide on the federal gift and estate tax. And you'll see the row with the blue shade right there is the estate exemption amount is $11.7 million. So that's telling us that most of us don't have to deal with this problem, right? This is a problem that doesn't impact most Americans because most of us don't have $11.7 million. If you're a married couple, each spouse gets $11.7 million. So a married couple can have, $23.4 million that's shielded from federal gift and estate taxes at your passing. If you're over those thresholds, then you are subject to a 40% tax rate on any assets over those amounts that you're passing on. And then the first row, the annual gift tax exclusion, is the most amount of money that any taxpayer can give to another person and not have to file a gift tax return.
I just want to emphasize you can give away $100,000 a year, and it's excluded from having to pay a tax. The only thing you would have to do is file a gift tax return. People are very confused on that. The gift tax exclusion means that you don't have to file a gift tax return.
Yeah. And just because you're filing the gift tax return doesn't mean you have to pay taxes. That's part of the confusing thing. There is a compliance requirement to file the return, but very rarely are taxes actually paid with gift tax returns when they're filed. Okay, so we're moving on to income taxes now, and this is where we'll spend most of today's session. So I'm going to talk about income, deductions, some what I've called other taxes, and then we'll talk about some recent law changes as well. Okay, so one of the things that I like to do is distinguish between ordinary income and capital gain income. And the reason it's important to distinguish between the two is because there's different tax rates that apply to ordinary income and capital gains. And so right now on the left-hand side, you'll see the bullet points of what's considered ordinary income, okay? Wages, Social Security income, self-employment income would fall into ordinary income. Gain on the sale of assets owned less than 1 year. Gain on the sale of annuities, rental income. So all these things are subject to ordinary income tax rates that we see over on the right-hand side. And those rates vary from 10% to as high as 37%, depending on how much income you have. Now, capital gain income, you can see there's fewer bullet points under capital gain. So qualified dividends, and then gain on the sale of assets owned greater than 1 year is going to be taxed at capital gains rates. And those rates vary from 0% to 20% on the high end. So the capital gains tax rates are lower than ordinary income tax rates.
So when you try to put a portfolio together for someone, you would try to weigh the income to receive the capital gains kind of income versus the ordinary income.
Yes. Yeah. When we build investment portfolios for clients, we're definitely considering the tax implications of the securities that they own.
Yeah. It's amazing to me that a single person can have $40,000 worth of gain and pay zero taxes.
Yep.
I have a question. What is a qualified dividend? Do you have it on your capital gains?
Yeah. And so There you have qualified dividends and non-qualified dividends. Non-qualified dividends would fall under the ordinary income. Qualified dividends, more favorable capital gain tax treatment. Qualified dividends are going to be primarily U.S. companies. You also have some foreign companies that will issue qualified dividends, but you've got some non-qualified dividends are going to be more like real estate investment trusts. When they pay out income or dividends that's considered non-qualified, and you also have some foreign or non-U.S. companies when they pay out dividends they're considered non-qualified dividends. So your blue chip stocks, most of the big U.S. companies that you would think of when you think of big publicly traded companies are going to fall under the qualified dividend treatment.
So when you're putting together a portfolio, you really keep in mind the tax implications from of the portfolio, depending on what bracket everybody is in.
Yeah, exactly. No, it's important to consider the taxes and when building out a portfolio and looking at the different tax implications of different accounts, right? If we have money in an IRA account, we might want to invest that differently than money we have in a taxable brokerage account.
Yeah. I noticed that you have income on annuities. Is that ordinary income?
It is. It is. Yeah. Gains on the sale of annuities is taxed at ordinary income tax rates.
And even income coming from an annuity while you have it is ordinary income?
Correct. There's a portion of that income that's attributed to the original investment called basis that you would not pay taxes on. But then there's a portion of that that is going to be taxed at these ordinary income tax rates.
Okay. And so you would not call annuities a tax-wise investment?
Typically not. They do offer some tax deferral benefits, but when you're withdrawing the money, you are subject to the higher ordinary income tax rates. Whereas if you did not invest in an annuity, you could pay these lower capital gains rates.
If someone were to, and I'm going to ask you to be a consumer, and you go to a financial advisor, and they never look at your tax return, what would you think of that particular individual as a financial advisor?
Yeah, there's a huge missed opportunity for advice if an advisor is not looking at your tax return.
Yeah, it's almost, by the way, all of our financial advisors that are being presented, and there's and others in the past, offer a free hour and a half review of your present holdings. Marty, I'm assuming, but I want to make clear, do you offer that to clients or prospective clients if they want to come in and see you? Will you give them an hour and a half for you to take a look at their investments?
Of course, we're happy to do that.
And that's absolutely at no obligation and at no charge.
Correct.
Okay. When they come in to see you, or what should they bring?
We like to look at tax returns and recent account statements.
Okay. So the tax return is literally one of the most important items for you to review to give any kind of an opinion as to how well they're doing.
Correct.
Okay. Let's go to the next slide, unless there's some questions.
So we talked about income. Now let's look at deductions. And deductions are what help us reduce taxable income, right? This is typically money that we're spending or just deductions that the government gives to anybody, known as the standard deductions that you can use to reduce the amount of income you're having to pay taxes on. And so on the tax return, you've got the opportunity to fill out Schedule A, it's called, for itemized deductions. And what you do is you use that schedule to figure out if your itemized deductions are going to be more than your standard deduction amount. The standard deduction amount is a amount that the government automatically gives to anybody to take. But if you do have more itemized deductions, your taxable income will be lower if your itemized deductions amount to more than those standard deduction amounts. And you can see for 2021, the standard deduction for single taxpayers is $12,550. And for married filing joint, it's $25,100.
It is estimated that for those over 65, that 70 to 80% of individuals just take the standard deduction today. Because as you can see, you've got to go over that amount of the standard deduction in order to get an itemized deduction to make it worthwhile.
Yeah, especially with the 2018 tax law changes, Pete, the standard deduction amounts went up. They basically doubled. So you had just more people taking the standard deduction for that reason. The other thing that happened was the 2018 tax law changes limited the state and local tax deduction to just $10,000. And that's taxes paid to the state of California, any other state. It's also property taxes that are limited in that same $10,000 cap. But some of the other common deductions that we see for itemized deductions, medical and dental expenses, interest paid on a mortgage for a primary residence, and then charitable gifts.
Marty?
Yeah.
I have a question from the previous slide, not the one where it had all the brackets on there. Someone's asking why on ordinary income, on the ordinary income categories, how is it possible they are taxed at different rates? It's a little confusing.
Yeah, so maybe we can work through that. If we just take an example of a single taxpayer that made has $30,000 of taxable income. Okay, that first $9,950 would be taxed at 10%. Okay, and then the amount over that $9,950 would be taxed at 12%.
Okay, right? Okay. I think the confusion was people are reading this. So the rate value should be assigned to the ordinary income on the right, not to the wages is 10%, interest is 12%, Social Security is 22%. You see what I'm saying?
Yeah, you're right. The slide's a little confusing. We should put a line in there to.
Yeah. So all ordinary income can be in one category, but it depends on which marginal tax bracket you're in, as to what rate you will pay. Correct. Okay. Thank you for clearing that up.
Yeah, stay on the slide for just a second, because I think you brought up an important point that not all of your monies are taxed at one rate. Mm-hmm. Your money's taxed at different rates. And so I think each person needs to know their effective tax rate, especially at the end of the year. For example, if you made $30,000 and you're single, you may want to take, and you have an IRA account, and you may want to consider taking out a little bit more monies up to the $40,000 category, because you know that it's just going to be taxed at 12%, that additional amount. So you need to understand your effective, is that what it's called, Marty, your effective tax rate?
It's the marginal tax rate.
Marginal tax rate, okay.
Where we see the ability to identify planning opportunities like you're suggesting, yeah.
Yeah, so one of the things as well, what makes the entire financial service, when we talk about money, sometimes difficult is just the vocabulary. The marginal tax rate is what we were just talking about, but if you don't understand what marginal means, then you're going to be kind of lost. But it's that rate that the last rate of your income for that particular year.
Yeah, it's the rate that you pay on your last dollar of income.
Much better said. Okay, let's go back to the last slide you were on.
Okay. So these are some other taxes to be aware of. The first one is the net investment income tax. Okay, and that's a federal income tax that applies to capital gains and dividend income. It kicks in at over $250,000 of income. Okay, for married filing joint couples. So for a lot of us, we don't have to pay that. Some of us, we do have to pay it if we're over those thresholds. But it is an additional tax by the federal government. It was tied to Obamacare when that was enacted. The other big tax, especially for those of us that are residents of the state of California, is state income taxes. And those can vary. Most people end up paying about 9.3%, families that are having wage income, but you can go as high as 13.3%.
Yeah, I think it's the earnings is about, you pay close to that 10% when you get to the $60,000 level of income.
Right.
And does California have a capital gains tax?
No, California does not distinguish between ordinary income or capital gains. The same rate applies on all income in California.
So it becomes pretty imperative when we're looking at income and we look at our return on our investments. We could see that the tax issues have an enormous impact on it. So do you calculate your client's return after taxes or before taxes?
We do both.
You do both?
Yep.
I think most of us should at least take a look at what our after-tax return is, because that'll give us a better real return rate, because that's the money we get to keep in our pocket. And most advisors do not. And by the way, when I talk about advisors, I don't consider, for our, speaking of definitions, in our program, I don't consider a broker a financial advisor. I consider a broker a broker. A broker is a professional, but they're brokers. And a broker has a different standard of care. They have what's called suitability. On the other hand, I call individuals like Marty a financial advisor because they're fee only and they only offer their services to you, not financial products. So when somebody engages you, Marty, to be a financial advisor, and after 3 months, they go, Marty, I really don't like you. How do I get rid of you?
Oh, that's easy. Yeah, I mean, so it sort of depends on, right, how we're engaged. But if we're just engaged for financial planning services, then we can just delete their information from our software that we've used for those services. If we're engaged for investment management and we have accounts that our firm has a limited power of attorney to access, we will just call the custodian, typically Schwab or TD Ameritrade are the two that we work with, and we'll tell them to remove our firm from those accounts. And so the client still has their accounts with the custodian and all their money is still in those accounts. The client just transacts directly with the custodian instead of going through our firm.
Yeah. Whereas if you're with a brokerage firm and they have invested your monies in a mutual fund that it has a commission on it, there is just no way you're going to get a return of that commission. that money is lost. And we'll get more into that in next week's session. Let's go to the next slide.
Okay, so this was a 2019 tax law change, and the law was, had a lot to it, but some of the highlights that I wanted to touch on was that IRA distribution. So when you put money into a 401k as an employee or into an IRA, you get you don't pay taxes on that money in the year you put it into the account. But when you take the money out, you have to start paying taxes. And so the government forces you to take money out of IRAs once you hit age 72. Prior to this law change, that was age 70 and a half. So they pushed it back to age 72. And there's a small amount of your IRA that you need to take out. It ends up being about 3.5% the first year. And it grows a little bit every year thereafter. But that, go ahead, Pete.
We're gonna get into the RMDs and the Roth and the regular IRAs in the It's Your Estate session on retirement planning. So we're just doing it very briefly here, just to be aware that because it used to be that RMD started at what, 71 before, or is that age 72 a change?
Age 72 is the change. Yeah, it was age 70 and a half before.
70 and a half.
The law was a little quirky in that you had until April 1st of the year after you turn 70 and a half to take the distribution. But it's now, we don't have to worry about that half age anymore. It was always a little bit of a confusing calculation to look at somebody's half birthday. Now it's 72.
Yeah. Let's go to the next slide.
All right. Okay, so this is another law change that happened this year. This was under the Biden administration, and the most recent round of economic impact payments as coronavirus. We've seen a series of these payments come out. And so I think this is the fourth round of those. So $1,400 per individual or dependent. There's income thresholds, so that it phases out if your income's over $75,000 for an individual taxpayer or $150,000 married filing joint. Those $1,400 amounts start to get shrunk down to the point where they just fade away at some point. Child tax credits were increased. Okay. There's some other small business and homeowner assistance related items as well.
Let's go to the next slide.
I have a question.
Okay.
I don't really understand. There's a question that says, are EIP taxable? You heard of EIP?
Economic income payments.
Okay.
Yeah. Or impact, economic impact.
Yeah, that makes sense.
No, they're not taxable. And one of the things that that came out with this law change was related to unemployment income. And they made the first $10,200 of unemployment income non-taxable. So the problem is they had that law come out in March, and some people had already filed tax returns. And so there was a lot of confusion around, well, what do? You need to file an amended return. And the IRS ended up coming out and saying that there's no need to file an amended return if you had unemployment income and you reported it as taxable, that they will do the calculation for you and issue you a refund. So there's no need to file an amended tax return if you reported unemployment income as fully taxable when it should not have been reported that way.
Just a heads up, guys, we got 30 more minutes.
Okay, thank you.
Sure.
Okay, great. So potential income tax changes with the Biden administration. There's been a series of hypothetical scenarios that are coming out, and we are expecting that tax rates will go up on people with income over $400,000. Okay, so most Americans don't exceed those thresholds, but those that do can be looking at higher taxes. I don't want to get too far into the weeds on some of the hypotheticals here because they are just hypotheticals. And as we know, the politicians will end up, changing things and negotiating. But it is likely that new tax laws will be coming here this year at some point. One of the questions that comes up is when will those new tax laws be enacted, right? So would those tax laws take effect at the end of the year, at a midpoint, during the year? We don't know. It could really happen either way. We think it's highly unlikely that those tax law changes will be retroactive to January 1 of 2021. We do not think that'll happen. I think back to some Bush era tax changes that happened, and it was May 5th. They had the tax law change. And so there was kind of a line in the sand when and at that point in time, the tax rates went down. And so if you had income events happening after May 5th, you were subject to a lower tax cost than if you had the same income event happen prior to May 5th of that tax year. I think something like that could happen, but it would be the other way around where we could see tax rates actually going up after a certain date in the middle of the year, or it could potentially just be something that happens January 1 of 2022.
You put down here the limit size of retirement accounts, IRAs, or what do you mean by that, or what is meant by that?
Yeah, so what is being talked about there is potentially reducing the amount that can be put into accounts, the contributions that can be put in, and they may also look to see how much money you have in those accounts to prevent you from being able to put more money into those accounts.
Are we talking about, do you know what kind of limits that they're talking about, or is it?
I don't know the amounts. I suspect it would be pretty high dollars that wouldn't impact most Americans again. Yeah. And that's really who they're going after. They're kind of going after, it's probably the top, 10%, maybe the top 5% of income earners or people that have a lot of money. You see the wealth tax bullet point on here has been brought up.
Yeah, it's the you're going to read a lot in the popular media as to potential tax changes. Just make sure you don't panic, because as Marty said, they're usually aimed at the top 10% of income in the United States. And those individuals who are in the top 10% of income usually have individuals like Marty helping them reduce their taxes. So if you are one of those individuals that have, it's incumbent upon you to use the professionals out there, because there are it is complex. And unless you really get into the weeds on some of these things, you really don't know what the real story is. So do not panic.
And it's possible, especially for those of you with income under $400,000, you could actually be looking at more credits, which would save you money on taxes. So you could be looking at a more favorable scenario moving forward. I suspect it'll probably be on those with income far less than 400,000. But you can see that I think it's the third bullet point from the bottom, the increased credits. So you could have higher child and dependent care credits, credits for renewable energy, first-time home buyers, and retirement savings to incentivize those with incomes incomes under 400,000 to save more money in retirement accounts.
Yeah. So our savings rate in the United States is really poor. And so they're trying to encourage individuals to save money. And now with COVID and everything else, it becomes even more important to do that. Let's go to the next slide.
Okay, before I go there, Pete, I just want to touch on one or two more bullet points on this. So the second from the bottom is, I think, a pretty big potential deduction that could be coming back, especially here in California, where state income taxes are so high. That limit on that deduction on the federal tax return was capped at $10,000. So property taxes, state income taxes, you know, anything over $10,000, we got no federal tax benefit for. That would be really nice to see that come back for the, you know, the blue states, they call them, which is California and New York, that we think of with the highest tax rates, where there is a potential tax savings opportunity there. So even though rates could be going up, if you get a deduction back, that could really help offset some of the rate increases that we would be looking at. And then the other thing that's been talked about is that last bullet point, just the corporate tax rate increase. So in 2018, corporate tax rates were dropped to 21%. And now Biden is talking about bringing those back up. The number that's been thrown out there is 28%, but I know that he's openly said he's willing to negotiate that to a lower percentage. So we'll see what happens there. But that's something that could impact investments that we have in publicly traded companies, which are mostly corporations. So,
alrighty, next slide.
Potential estate tax changes. So this is a pretty big one. I think the estate tax exemption was basically doubled in 2018. So that's, you know, if we think back to earlier in the presentation, that was the $11.7 million number that, you know, doesn't impact most of us, but they're talking about dropping that from 11.7 million per person to $5 million per person. And again, this is the amount of money that one individual can pass on tax-free to their heirs. So if you're a married couple, you'd be able to double this. So, you know, dropping that from 23.4 million to $10 million for a married couple, you could see substantially more families being subjected to the estate tax. And they're also talking about increasing the rate on estate taxes as well. So we'll see what happens there. There hasn't been anything definitive yet, but I would not be surprised to see that 11.7 million number dropped to something in the range of 5 million. There's other changes that are happening. I don't want to get too far into them, but some of the methods that are used by wealthy taxpayers to reduce the portion of their estate that is subject to taxes. There's legal mechanisms that can be used to do, you know, for families to gift assets and not have to pay taxes on it. But the government is talking about removing some of those mechanisms to enable families to skirt their way around the estate tax.
Yeah, the estate tax is almost a volunteer tax. It's if you were to get together with your CPA and financial advisor, you literally could avoid paying any estate taxes, no matter what the size of your estate is. Warren Buffett will probably pay 0 estate taxes because he's using a charity. He's giving away all his money. And so he will likely not pay any estate taxes whatsoever. Neither will Bill Gates. So estate tax changes come around very slowly. But for most of us, we don't have to worry about it. And we'll get more into it in the It's Your Estate session.
Great.
Next slide.
Okay, so I think this is the last slide too, but this is good because this is my favorite topic when it comes to taxes, and it's tax planning. So we are, it's important to understand everything we talked about, but I think at the end of the day, we want to ask ourselves the question, well, what do we do about that? And what can we do with that knowledge to reduce taxes, and keep more of our money and give less to the government? So The first one, defer charitable contributions for larger benefit if rates likely to increase. So if we think that rates are going to be higher, whether that's later this year or even next year, and we want to make a large charitable donation, we might decide to hold off and do that when tax rates are higher. We'll have more benefit from making that charitable contribution a little bit later. Accelerate deductions to avoid limitations, right? One of the potential tax law changes was to limit itemized deductions. And so you might consider, accelerating deductions and paying some of those expenses today instead of waiting. Qualified charitable distributions from IRAs. So the laws changed to allow clients and taxpayers to take money directly from an IRA and send it to a charity. And by doing that, they did not have to take their required minimum distribution. Now, the 2019 law change that forced your first distribution out of an IRA at age 72, it's weird. They still kept the qualified charitable distribution age 70 and a half. So once you're 70 and a half, you can take money out of an IRA and give it directly to a charity. And that's actually going to be a more favorable outcome for you than pulling the money out and then cutting a check from your bank account to a charity. Because once you put the money in your own personal account, it's taxable income. And then you get a deduction, but it's actually better to not even have the income, to have zero income, than it is to have have a matching amount of income and deduction. Charitable remainder trust may not be as beneficial for those with high income, over $1 million, because of some of the law changes that are potentially coming down the pipe. Roth IRA conversions, or just taking money out of IRAs. If you're planning to take money out of an IRA account or retirement account, it might make sense to do it sooner this year than later in the year if rates go up. Accelerating gains is another consideration, right? We know what the capital gains tax rates are today. We looked at those earlier. They're 0, 15%, or 20%. If those rates go up to a higher amount, we may want to actually sell some investments and pay taxes at a lower rate today than waiting and doing that down the road.
Marty?
Yep.
I got a question, and Pete, you could probably chime in on this too. It says if they limit itemized deductions to 28%, doesn't that hurt charitable deductions if you have a carryover for doing a charitable remainder trust?
Great question.
It was limited to 30% of AGI for that, but if total itemized is limited to 28%, then why give?
Yeah. So typically, and this was they called it the P's limitation. So charitable contributions were not subject. They got a special category within itemized deductions for charitable donations, and they were not subjected to that limitation. There are still other limitations that are based on your adjusted gross income that you need to be cognizant of for charitable giving. And it depends on what type of entity, what charitable entity you're making donations to and what asset you're using to donate. But if you're just writing a check and you're giving cash to a charity, that's right now limited to 60% of adjusted gross income. So it's possible that, you may want to accelerate other deductions, other itemized deductions, but still defer charitable contributions.
And remember, this is all planning considerations, okay? These are not facts. This is potential changes that might take place. So things to look at, to consider, but don't act on them yet.
The ink is not dry.
No, not at all. It's good. A lot of politics are involved.
Exactly.
You know, so nobody can predict the future. So don't. What happens many a time is that attorneys, sometimes major CPA firms, in order to drive business to them, they use fear tactics. So don't be led astray by fear. Your taxes will increase if you don't do blah, blah, blah. I think about, I can't remember, 5 or 6 years ago, people were setting up special trust for kids. And because they thought the tax law was going to change and to lower the estate taxes or to lower the estate tax bracket. And a lot of people went ahead and did irrevocable trust for their children. They're now kind of sorry that they had done that. So be careful when somebody is trying to generate professional fees based on fear. Just be careful.
Yeah, what I like to do, Pete, I like to look at all these considerations, and I'll go back to one of the earlier slides here and try to understand and project where clients are going to fall based off of these tax brackets, right? We know that this is kind of the system we're working with. These rates on the left-hand side or in the middle of the slide, the rates might change, but we know that the more your income, you're going to pay a higher share of that to the government. And so if we have a reason to believe that clients are going to have a year where they've got a really high income event because they sold a company or they sold a piece of real estate, that would be a year where we're going to look to make all these deductions happen in the same year because those deductions are more valuable when we're paying higher tax rates. Vice versa, if we know there's a year where income drops off for some reason, maybe somebody lost a job or they had a property that was vacant and not rented out, where in past years they did have rental income, we may want to look to accelerate income because we're paying lower tax rates. And so I think that's really the key, is understanding your situation, right? Your marginal tax bracket, marginal tax rate, and knowing what that next dollar of income is going to be taxed with should you choose to generate that income. And that the offset to that is just the deduction, right? Well, how valuable is that deduction to you in a given year? And that can change. So it's really those big changes in situation or an income that we want to look at to understand what tax planning opportunities are available to our clients and what can be done.
Thank you, Marty. I really appreciate that. Trevor, how much time do we have left?
About 12 minutes.
All right. Was that the last slide, Marty?
Yeah, that's the last slide. I still have a couple more. Let me go back. A couple more.
Why don't you go ahead and wrap it up?
Okay. Okay, so that last one on estate taxes. So if you do have a taxable estate, or if you are concerned that the new estate exemption will be low enough to make your estate taxable, the IRS has come out and said that they're not going to claw back any gifts that were made under this current $11.7 million amount. So again, this is not going to apply to most taxpayers, but if you are in that situation where you have a taxable estate, or you could potentially have one, it might be a time to consider making gifts and knowing that you would not be paying estate taxes on those gifts right now, and nor would you be doing that in the future, even if the estate tax threshold drops from 11.7 million to say $5 million. So I think there are a lot of attorneys out there that are getting really busy because there is a concern around that. So for people that are in that situation, that fortunate situation, it's something to consider doing sooner than later. So that was just one thing I wanted to highlight.
Okay. Anything else?
Thank
Nope.
you. Thank you for having me.
You're welcome, Marty.
Last but not
Thank
least.
you.
Okay.
That was an excellent presentation. And we put this presentation in instead of our regular financial quiz because taxes are such a huge part of our financial life. So what I'd like to do now is
Marty, go ahead and stop sharing your screen. Great.
Wow.
There.
Our photos on the screen are a lot larger this time than it was last time. So it's a little bit of a shock to see my face on the screen. I put an immense amount of material on the website for people to take a look at. But I also want to talk a little bit about financial and estate literacy. My background, which my Ask First form is on the material, and you could take a look at that. We've been doing this program for 25 years. The reason for the program was when I was at Long Beach State University, that most of highly intelligent individuals didn't know anything about money. School teachers, professors, people had even their MBAs had no knowledge of their own finances, consumer finances. And so they didn't know the difference between a broker and a fee-only advisor. So we started putting a program together for the professors and faculty and staff at Long Beach State University. And then when I went to work for the American Red Cross, we got charities together and with the same thing. It's my personal belief that we pay way too much to the financial services professionals for the hard money that we earn. And so most of your fee-only advisors charge less than a typical broker. A typical broker would cost you approximately 3% per year, but it's very difficult to find out how much and where they're getting paid. So whereas a fee-only fiduciary advisor will send you quarterly statements, will tell you exactly the amount that you have paid them. So that's really important. The other thing too is that there's so many other things that are more important than the investments. What you're going to find out through our program, I believe, is that the investments is kind of like the apple rolling off the cart. If we know your goals and objectives, if you know your risk tolerances, if we know your tax bracket, if we know your estate plan, then we can put together the investments that will relate to your goals and objectives. They just don't happen outside that norm. What I find is that most brokers will not ask you about your net worth, or will not ask you about your cash flow, will not ask you about budgets, all important things. In fact, I recommend it to my son, who's 32, and I recommend it to other individuals as well. One of the gifts that you can give your children is that to send them to a fee-only financial advisor. And they only maybe need to meet with them 2 or 3 times just to get started on the right path as to what to save and how much to put into retirement savings, and to ask questions about whether or not they ought to lease a car or regular advice, how to work their first home buying opportunity for a mortgage, etc. So some of the articles that I've included, the worst money mistakes a person can make. In this particular article, I found it really useful, you know, of some of the items. Paying for subscriptions you don't use, not returning unwanted purchases. My favorite store to shop at is Costco because it's the easiest place to return items. Paying too much in banking fees. You know, I only use a bank by if they will take my calls and say, return my fee for an overdraft. You know, the banks today make more money on fees, overdraft fees, than they almost do on any other area. You know, if planning a vacation and you haven't paid for the last one, overspending on gifts. You know, it's sometimes we equate gifts with love, and you shouldn't do that. Overspending in general. There are spendthrifts out there, and they're part of our families. And the more children that we have, the more likely that one of our kids is a reflection of society as a whole. So in the estate area, we'll get into more as to how to leave money to a spendthrift kid or someone who doesn't know how to budget.
Pete, I'm just helping you move on a bit. A lot of people associate financial illiteracy with young people. They say, well, you know, these 20-somethings don't know anything about money. Is it true that once we age, we automatically just become literate all of a sudden in financial matters?
No, it's probably as we get older, we probably know a little less about financial literacy than we do when we're younger.
I notice you have a lot of articles on this that talk about that.
Yeah, and they're for you to read. I always recommend that when the first spouse dies or becomes lacking capacity, that the surviving spouse meet with a fee-only fiduciary advisor. You need to be able to trust someone to help you with making money decisions. Just on taxes alone, it's complicated. There are over 18,000 mutual funds. You know, if you want to confuse somebody, give them 101 choices. And that's kind of what the financial industry does. Besides the fact that who has the money in the United States? Older people. And so when you have accumulated wealth, you're going to be subject to more scams. They have marketing seminars on how to get at your money. So, you know, I don't want to, this is not a scare session, but you need to understand the financial services industry. Fiduciary duty to clients, you may want to take a look at that. It talks a little bit about what that means. It's also a kind of a philosophy. You know, when I see a fee-only fiduciary advisor, I see them as a vocation. When I look at a broker, it's more of a business. And so, you know, have your own opinions on that.
Well, Pete,
yes,
we are, I mean, let's end on that note, because next week, as we're running out of time here, next week we'll be going deep into that. We are going to be talking about products that are sold, as well as going into the difference or identifying the difference between a financial advisor who is commissioned to sell and those that are not selling anything. Any last words to our audience as to what to expect next week?
Next week, we're going to go into annuities and mutual funds, and we'll talk a little bit about how mutual funds are paid and what to look for. Okay.
Great. And then tomorrow morning, those of you that are registered, we will be doing the It's Your Estate series we're starting. There will be we are doing a tax update on that, and there will be some overlap, although we are planning to go into more, also discuss the recent property tax changes that we have, that the recent propositions have brought about. Thank you very much for participating, and look forward to seeing you either tomorrow or next week.
Thank you, Trevor. Thank you, Marty.
Thank you. I'm going to answer a couple questions real quick, and then I'm going to end the webinar. Okay.
Are you going to answer the question verbally, or are you answering the question?
Yeah, I was just trying to get it on the record. No, it's just if I miss a seminar, you're recording it so I can watch it later, right? And yes. Where? So I say, yes, you are. Yes, we are recording it, and these will be on our website. Yes, we are recording, and they are located on our website. And I'll every time I'll remind people where to find that. Okay.
Yeah, and the other thing too is that we're also very open to suggestions. This is just the second time that we've ever done this as a Zoom virtual presentation. So we hope that it comes over well for you, and your feedback is very important.
Yes, those are our aspirations. Okay, thanks, Pete.
Thank you, Trevor. Bye-bye.
Bye.